let's now talk about some of the other clauses related to the governance side. Fortunately, fewer changes coming about in this one. We can quickly run through some of those changes and then take it further. When it came to compliance with laws and regulations, there were about 6 or 8 clauses that we thought we should pick it up with you. The first one was around reporting on whether the company has complied with section 185 and 186 of the Companies Act. If you recall, section 185 prohibits loans to companies in which directors are interested, and section 186 governs the granting of loans, guarantees, or providing securities to a person or any other body corporate. And it has restrictions around the layers of investments. Absolutely no change from CARO 2016 to CARO 2020. The same procedures that one would have expected to have performed in the old CARO will be continued to be performed in respect of 185 and 186. CARO 2016 also required a commentary around situations where a deposit was accepted. CARO 2020 says that if there is a non-compliance with section 73 to 76 of the Companies Act, or non-compliance with the RBI directives for deposit acceptance, or with non-compliance of an order of the Company Law Board, those are the non-compliances that need to be reported. What has only got added is that deemed deposits have been now specifically included to make the clause more tighter. But from a practical sense, we don't think this has a significant reporting implication for preparers as well as auditors. You would also recall that Companies Act section 148 requires certain companies that are engaged in the manufacturing or production or services to maintain records on utilization of material, labor, and other items of costs, which means they are required to maintain certain cost records. The auditor had to comment for those entities whether the cost records have been appropriately made and maintained. And that reporting requirement continues unchanged in CARO 2020. There were 2 more clauses in CARO 2016 dealing with statutory dues. The auditor was required to report on the regularity in payment of undisputed statutory dues, and if there were arrears of such dues for more than 6 months at the balance sheet date, those reporting requirements were triggered. Similarly, if there was a due which was not deposited on account of any dispute, that was also specifically required to be disclosed by the auditor. Once again, CARO 2020 does not change those reporting requirements. It only includes the GST to be one of the statutory dues. From a practical standpoint, even last year when the auditors would have audited this, they would have considered GST to be a statutory due, and that logic would continue even in the current period. So to summarize, with respect to these 4 items, no significant changes vis-a-vis CARO 2016. If I move on and pick up some of the 4 other items to talk about, compliance with section 177 and 188, these dealt with related party transactions. Section 177 dealt with the audit committee approvals, and section 188 dealt with the process of approval of transactions not in the ordinary course of business and not at arm's length. The CARO requirements in 2016 and 2018 has remained as it is, no significant changes. If there is non-compliance, please report. If the disclosure requirements of the accounting standards have not been met with, please disclose. And same way with compliance under section 192. Section 192 dealt with non-cash transactions with directors or persons connected with directors. Once again, the evaluation of whether such transactions have happened, and if they have happened, whether they were or whether the approvals were sought in compliance with Companies Act 2013 is what the auditor needs to report. So once again, no change in the reporting requirement with respect to this clause. There was one reporting requirement with respect to compliance with 197 and Schedule 5 for managerial remuneration. That reporting requirement has been taken off from CARO. Auditors used to report on this in the primary audit report as well as CARO. The CARO requirement has now been dropped. Finally, one new clause that has been introduced, and this is an interesting clause, is reporting of unrecorded income in the financial statements that was surrendered or disclosed in the tax assessments. Now, this is a new reporting requirement. What this reporting requirement suggests is this clause is applicable only when the transactions are not recorded in the books of accounts and have been surrendered or disclosed as income in the respective year's tax assessments or in the tax assessment. What undisclosed income means or includes is the Income Tax Act 1961 provides guidance around this. It includes money, bullion, jewelry, any documents, any goods as undisclosed income, which are then considered or deemed to be income or assessed as incomes. Similarly, if there are allowances or deductions that were claimed, which were not approved and had to be added back or had to be disallowed, those could also be considered to be reportable. But the emphasis here on this reporting is surrendered or disclosed, which means only if this is something that the company has done voluntarily does the disclosure requirement trigger. If the company has disputed the department's contention, has disputed this claim, the auditor will not be required to report under CARO. So that is what we had to talk about in terms of the governance or the compliance related aspects. One change that is meaningful is around the unrecorded incomes. No other significant changes for management and for auditors. For this one, the key item would be looking at the income tax assessments and seeing if there is any item which relates to assets specifically, which is then accepted or voluntarily offered for tax as income. For this part, we had covered the first three themes. In the next part, we will talk about some of the audit related aspects and what it means for the auditor, what it needs for the auditor. That is what we wanted to cover in today's session. If you have any questions, please feel free to write to us.